In a world where trillions shift with a single algorithm, most investors are left in the dark, betting their wealth on wild hunches, gambling. But what if there was a way to truly understand the future of finance, to stop guessing and start knowing? Noted financial scholar Dr. López de Prado saw the flaws. He witnessed the rampant statistical overfitting, the business-as-usual techniques that didn't just fail, they actively lost money. He exposes the mathematical sins of finance, yes, but he also offers something far more powerful, a technically sound roadmap for finance professionals to embrace the wave of machine learning. This isn't theory for paper, it's real-world data analysis. Chapter 1. A distinct discipline. For decades, finance relied on simplistic statistical techniques. Now, machine learning promises a revolution, but with immense promise and peril. Dr. López de Prado's book is the first to characterize why standard ML tools fail in finance and how to solve those unique challenges. This is not standard ML, this is financial ML, a subject in its own right. The root cause of failure, the Sisyphus paradigm, expecting individual PhDs to build an entire car alone. The solution, the meta-strategy paradigm, a research factory where specialized teams build discoveries at a predictable rate, just like Berkeley Lab adds elements to the periodic table. Chapter 2. Data structures. You can't build a fortress on quicksand. Most financial data is noisy, unstructured, and filled with human anomalies. This book teaches you to move beyond traditional time bars to information-driven bars that capture the true pulse of the market, like volume bars or dollar bars. We're talking about working with truly unique, hard-to-process data sets that your competitors probably gave up on. Chapter 3. The secret code. How do you even define success or failure? Traditional fixed-time horizon labeling is flawed. This is where the triple barrier method comes in, setting dynamic profit-taking and stop-loss limits that are a function of actual risk, and then meta-labeling, a revolutionary technique allowing an ML model to enhance your existing investment strategies, even those based on human intuition. It doesn't decide if you bet, but how much. It's how the quantamental revolution begins. Chapter 4. Unmasking redundancy. Most ML algorithms assume your data is independent and identically distributed. Finance is not IID. This is the equivalent of trying to measure cholesterol when blood from multiple patients is spilled into every sample. This chapter provides the tools, sequential bootstrap, and sample weighting to clean that mess, ensuring your algorithm learns from unique information, not just redundant noise. Chapter 5. The memory dilemma. Returns are stationary but memory-less. Prices have memory but are non-stationary. It's a dilemma that has plagued financial research. Standard differentiation wipes out crucial memory. The solution? Fractional differentiation. It preserves as much memory as possible while achieving stationarity, unlocking predictive power previously lost. Chapter 6. The Ensemble. Combining multiple weak models can create one powerful one. But in finance, where observations are redundant, even random forests can overfit. You need tailored ensemble methods, controlling for data uniqueness to truly reduce variance without introducing new flaws. Chapter 7. The critical test. Cross-validation is supposed to prevent overfitting, but in finance, standard CV fails. It contributes to overfitting, because information leaks. This book reveals the truth. Purged K-fold CV and embargo. Techniques that rigorously prevent leakage, ensuring your model's performance isn't just a statistical fluke. It's the only way to know if your model generalizes to the unseen. Chapter 8. The True North. Listen closely. This is Marcos's first law of backtesting. Most financial research commits scientific fraud by blindly chasing attractive backtest results. Adjusting a model based on backtest results is dangerous. The true research tool, feature importance. It's how you understand why your model works before you ever simulate historical performance. It's how you open the black box. Chapter 9. Fine-tuning for survival. Hyperparameter tuning isn't just about making your model perform better, it's about making it survive. Without proper tuning using purged CV and recognizing the nuances of scoring metrics like negative log loss, your algorithm is likely to overfit and deliver catastrophic live performance. This is precision engineering for survival. Chapter 10. Sizing the bet. Your ML algorithm can be 99% accurate, but if you don't size your bets properly, you will lose money. This chapter reveals how to translate predicted probabilities directly into dynamic bet sizes. It's the difference between a good prediction and a profitable strategy. Chapter 11. The dangers within. Backtesting. It's essential. It's also one of the most misunderstood techniques plagued by the 7 sins of quantitative investing, like survivorship bias and look-ahead bias. But even a flawless backtest is probably wrong. Why? Because the better you get at it, the more likely you are to fall for multiple testing and selection bias. This leads to false discoveries, statistical flukes that will haunt your portfolio. This is Marcos's second law of backtesting. Backtesting while researching is like drinking and driving. Do not research under the influence of a backtest. Chapter 12. Beyond history. The traditional walk-forward backtest tests only one scenario, history. But history is just one random path, and it can be easily overfit. The solution? Combinatorial Purged Cross-Validation, CPCV. It tests your strategy across thousands of alternative scenarios, calculating not just a single Sharpe ratio, but an entire distribution of Sharpe ratios. This reveals the true robustness of your strategy, making false discoveries negligible. Chapter 13. The Synthetic Reality. What if you could test your trading rules on data that never existed, but could have? This chapter shows how to derive optimal trading rule parameters directly from the underlying stochastic process of market data, avoiding historical simulations entirely. It's how you can solve the problem of backtest overfitting before it even starts. Chapter 14. The Truth in Numbers. The numbers lie, unless you know how to read them. This chapter unveils the deflated Sharpe ratio and Marcos's third law of backtesting. Every backtest result must be reported in conjunction with all the trials involved in its production. This is how you assess the false discovery probability and avoid being misled by deceptively good statistics. Chapter 15. The Unseen Threat. Portfolio risk is well known, but have you considered strategy risk? This is the hidden vulnerability where small changes in precision, frequency, or payouts can render your entire strategy uneconomic. This chapter helps you quantify the probability of strategy failure, allowing you to design resilient investment approaches. Chapter 16. The New Allocation. Markowitz-style portfolio optimization is prone to instability and concentration. This book introduces hierarchical risk parity, HRP, a cutting-edge approach that builds diversified portfolios using graph theory and machine learning, even on singular covariance matrices. It's delivering lower out-of-sample variance and is revolutionizing how machine learning strategies are allocated. Chapter 17. Market Shifts. Markets don't stay still. They undergo structural breaks. Mean reversion gives way to momentum. These shifts create massive opportunities, catching most off guard. Learn how to detect these critical regime changes using advanced explosiveness tests like SADF and CUSUM filters, turning market chaos into predictive features. Chapter 18. The Information Universe. Prices carry information, but how much? Shannon's entropy and Lempel's Ziv estimators allow you to quantify the true informational content and complexity of price series. Is your market predictable or on the verge of a black swan scenario? Chapter 19. The Market's DNA. This is where the deepest insights lie. Market Microstructure. Unpacking fixed messages, understanding order cancellations, aggressor sides, and the volume-synchronized probability of informed trading, VPIN. Learn to recognize the footprint of informed traders and anticipate market manipulation before it strikes. Chapter 20. Unleashing the Beast. Machine learning is computationally intensive. This part dives into high-performance computing, HPC, teaching you how to build multiprocessing engines, vectorize your code, and harness the full power of your CPUs and clusters to tackle massive datasets in parallel. Speed, scale, and efficiency. Chapter 21. The Untamable Problem. Some financial problems are simply intractable for traditional supercomputers. They require brute force on a quantum scale. This chapter reveals how to reframe complex integer optimization problems for quantum computers. The future of finance isn't just about algorithms, It's about what machines can even solve. Chapter 22, The Frontier. The brightest minds at Lawrence Berkeley National Laboratory, LBNL, through their SIFT project, are already applying HPC and ML to solve critical real-world problems, from supernovas to preventing power grid failures. They even applied it to the 2010 flash crash, achieving 720-fold speedups in early warning indicators. This is where the future of finance is being built, quietly, powerfully. Don't be left behind. The financial landscape is changing. Those who embrace these advances will lead. Those who don't will be left behind. The future of finance is here. Like, share, subscribe, join the revolution. Don't miss out.